morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at some financial results from the conglomerate sector, one of the more interesting sectors on the Trinidad and Tobago Stock Exchange. And if I'm not mistaken, it's actually the second largest sector on the Trinidad and Tobago Stock Exchange. So, of course, certainly important to investors and investors' portfolios. Now, we're taking a look at two of our local grown but regionally diversified conglomerate companies. We're talking, of course, about Ansa McAL or the Ansa McAL Group, as well as Massy Holdings Limited or Massy, with both the groups reporting contrasting fortunes for their respective fiscal periods, which would have concluded in June, the 6-month period for Ansa McAL, as well as the 9-month fiscal period for Massy. Let's take a look at how those groups would have performed and what investors might expect in the coming months ahead. Turning firstly to the McAL Group, or McAL would have posted a diluted earnings per share figure for that 6-month period ended 2024 of $1.28 per share, a 13.3% increase from the $1.13 per share recorded in that prior comparable period of half year 2023. Now, that performance was driven by revenues, which were up just around 5.5% from $3.25 to just about $3.43 billion. Operating profits overall increasing a fairly healthy 12.8% from $323 million to just about $364 million. Profits for the period overall, after considering finance costs and taxation, etc., would have increased 17.2% from $220 million to just about $258 million. So certainly good reading for McAL investors at that half-year mark. When we take a look at profitability trends by segment, well, it was somewhat of a mixed bag in terms of performance, with ultimately overall positive for the group. The construction, manufacturing, and brewing section, of course, would have increased around 33% in that pink segment, from $160 million to $213 million. Banking and insurance increasing at 22% from $86 to $105 million in that blue segment. There was some contraction in the that slips me. I think it's the construction segment from 89 to 70. It's automotive segment rather, from 89 to 74 million, which was around an 11% decline. And media services, retail, and parent company also had a wider loss than the comparable prior period, from 24 million loss to 30 million loss in the half-year period of 2024. Now, when we take a look at the valuations of McAL, we can see, based on that green line and the trailing 12-month price earnings ratio, current price earnings ratio, that McAL, given its price increase, but also that significant earnings increase on a trailing basis from $2.12 at the half-year mark of 2023 to $3.15 at the half-year mark of fiscal 2024, has started trending towards more historical levels in terms of valuations from a price earnings ratio basis, after hitting a high of around 24 times in that half-year period of 2023, has trended back downwards to around that 20 times level, certainly moving in the right direction in terms of a value basis, despite or notwithstanding the increase in its share price, as well as its increase in earnings, which seems to be growing at a faster pace than that, at least for the first 6 months of 2024. Than the price increase for the period as well. Now, at a price of $63 per share, Ansa McAL, as mentioned, is trading at a price earnings ratio of 20 times, which is above the sector average of 13.2 times, and offers investors a dividend yield which is reasonably decent, around that 3% level, which is broadly in line with the sector average of 3.4%. So with revenue growth in mind, those elevated or slightly elevated valuations, of course, keeping an eye on that continued acquisition activity, and of course, McAL's continued pursuit towards its ambitious 2x goal, which is to hit a $2 billion revenue mark, or profit before tax mark, by 2027. Bourse is maintaining a market to weight ratio on McAL for the time being. Turning very quickly to Massy Holdings Limited, or Massy, well, the group would have reported an earnings per share figure of 22 cents per share, which is a 10.7% odd decline from the 24 cents recorded in that prior 9-month period of 2023. Now, revenue from continuing operations was up that 13% which is a positive driver, from 10.3 billion to just under 11.7 billion. However, that was not enough to boost the profit. So obviously, there would have been some increases in costs, whether one-off or recurring, which would have led ultimately to profit attributable to equity holders declining that 10.8% from 485 million to just about $453 million. Now, when we take a look at the geographical composition of Massy's profit before tax, or the geographical contribution, we can see that things are certainly trending in the right way. Trinidad and Tobago still its #1 jurisdiction in terms of profit before tax contribution, but of course playing a less significant role over the past couple of years now at around 32.5% in terms of contribution to overall PBT, with Barbados relatively stable at around 12.5% over the past few years. The Eastern Caribbean hovering at around that 11 to 12% mark. Guyana continuing to increase in terms of importance to contribution to PBT from 18% in 9 months 2020 to 25.6% in 9 months 2024. And of course, with its recent acquisitions in Jamaica, taking the ideal acquisition, we can see that Jamaica's contribution to PBT would have increased from around 3.1% in that 9-month period of 2023 to 11.2%, a much more significant contribution in the 9-month period of 2024. So the key takeaway for investors here is that the group is continuing to become more and more diversified by its acquisition activity outside of Trinidad and Tobago. On the other end of the spectrum, in terms of performance, we can see, as mentioned, that despite that revenue growth primarily driven through acquisitions, there would have been some narrowing in terms of profitability margins, particularly that profit after tax margin, which is ultimately what investors would be focused on, which would have narrowed from around 5% in that fiscal period, comparable fiscal period of 9 months 2023 to around 4% in that fiscal period of 9 months 2024. So certainly investors would be hoping that Massy can or should be able to turn that around in subsequent fiscal periods and return to the sort of profitability levels that they would have become a bit more accustomed to in recent times. So at a price of $3.55 per share, Massy stock is down around 18 or 19% year to date, and is trading at a price earnings ratio of 9.9 times, which is considerably below the sector average of 13.2 to 13.3 times, and offers investors a fairly attractive dividend yield of around 4.5% compared to that sector average of 3.4%. So again, keeping that revenue growth in mind, the geographic diversification and relatively attractive dividend yields at this particular point, Bourse is going to maintain its overweight rating on Massy for the time being. That's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse. Email us at invest@boursefinancial.com. And of course, you can check out our website where all of our research is absolutely free at bourseinvestment.com. And you can catch this article in today's business section of the Trinidad and Tobago Guardian newspaper. So until next time, stay safe, happy investing, enjoy your Independence Day weekend and holiday, and we'll see you next time on the Bourse Report.